What's up, y'all? This is Cole from the Free Trading Academy. We are learning how to make $1,000 a day in the Forex market. I hope this course has been good to you guys, man. We've covered a multitude of topics, supply and demand, support and resistance, how to combine with technical indicators, market manipulation. But ultimately, the goal here is to teach you guys how to see the market, not so much as retail traders, but as institutional traders, so that you're not on the wrong side of these ridiculous market moves. You're able to get in, get out, get your money, and then go to the beach or go somewhere nice and just enjoy your profits. So this video is probably the most important video in the entire series. If you don't take anything else away from what I've taught you, risk management is how you turn yourself into a hobby trader, into a professional trader. So, when I talk to people and, they ask me what I do, and, they always ask, are you really able to make a consistent living from trading? And I say, yes, I make more than enough from trading to take care of myself and my family. And especially if I'm talking to other traders, we always want to talk strategies and things like that, right? Like we're always trying to learn from one another. That's a great thing about trading. It's a universal language. But what I find is, what I'm doing isn't necessarily different than what a lot of other people are doing. This isn't some brand new thing that I've thought about. These are methods and theories that have been tried and tested for decades. So the difference between consistent traders and people who are able to trade professionally versus everybody else is that we are able to manage our risk. We have a solid plan, and we, more importantly, execute that plan. All right, so we're on the Euro USD chart, and then we have some notes here on how to make a quick and simple risk management plan. Just like in a lot of things with Forex trading, there's a lot of folks out there that profit off of making things seem more complicated than what they need to be. And I like to keep things simple, because the more layers you add to something, the more confusing it is, and the less likely you are to follow it. So it's really just comes down to 4 key steps. All right. So when you're first starting out, you have a new account. Maybe it's your own money, maybe it's somebody else's money, which again, I'm going to talk about how to trade other people's money in coming videos. So number one, you're going to determine what size account you're trading. All right. That's where it all starts, because that's where you're going to do your math from. All right. So determine what size account you're trading. From there, you will decide on your max risk or loss per trade. Sometimes I call it max loss just because mentally it's good to, again, get in that mindset that this is the amount of money that you could potentially lose. We love to think about how much you could make per day, per month. All right. But it's better to think about how much you could potentially lose per trade. It keeps you grounded and centered. Third, from there, you'll determine your lot size. All right. Okay. Determine your lot size. And then number 4, set a realistic risk to reward ratio. Realistic is a key, because in theory, sure, you could have a 1-to-7, 1-to-8 risk to reward ratio, and you'll never blow an account. But I mean, the odds of that actually happening, unless you're a long-term position trader who holds your trades for weeks or months on end, is very unlikely. All right, the market does not care about our risk to reward ratio, so it's good to keep them realistic. Get your pips and get out, and keep it simple. All right, so here's an example here at the bottom right here in this box. Quick math. So let's say we have a $10,000 account. All right, so again, if you're new and you're like, I have nowhere near $10,000, I'm going to show you soon how to trade other people's money in a matter of minutes. Okay, $10,000 account. So it's good rule of thumb to risk 2% per trade. Some people go 1.5. It's a little too conservative for me personally. Some people do 3.5. It's a bit too aggressive, especially if you're trading multiple pairs. And some of those instruments may be indices. And indices pay out a lot more than traditional currency pairs. All right. So say on this $10,000 account, we are risking 2% per trade. All right. So 2% of $10,000 is $200. Okay. So this is our total max loss. This is how much we stand to lose per every trade. All right. So from there, you will determine your lot size. Okay. So maybe you want to have a wider stop. Okay. If that's the case, then you would maybe want to trade one mini lot. All right. So this example covers trade scenario if you're trading one standard lot. Let's just say one mini lot. So one mini lot equals $1 per pip. Okay. On Euro USD. On some other pairs that have higher spreads, it's a little bit less, but generally one mini lot is $1 a pip. All right. So if you want to have a nice wide stop loss, then you could have a stop loss of 200 pips. If if one pip is worth $1, you're trading one mini lot, then you could have a nice wide stop loss. All right. If you're actually entering the order saying MT4, then it'll look like this. All right. 0.1 is one mini lot. 0.01, can I type today, is one micro lot. And that is actually 10 cents per pip. So that's like the smallest that you could trade. I don't believe not all brokers offer that, so you want to make sure that you're trading with a broker that offers micro accounts. And then one standard lot is like we saw earlier, $10 a pip. Okay, so you want to have a wider stop loss, then just lower your lower your lot size. Okay, but again, we're factoring in our risk to reward ratio as well. Okay, so if you have a stop, or if your risk is 200 pips, okay, so and you're saying you're going for 1 to 3, that's usually what I try to do. Then now you need to gain 600 pips to get that. So that is the con of having a wide stop loss is you need to have an even wider target. All right. So for me, in this scenario, and in most cases, I like to trade the standard lot. Okay. So in this scenario here, we're deciding that if we're going to risk $200 per trade, and we have a $10,000 account, we're going to trade one standard lot, which is $10 per pip. So that gives us a 20 pip stop loss, and we're aiming for 60 pips. So this is very realistic. For context, pound yen, which is GBP, JPY, this pair over here. I didn't mean to do that. That pair moves about 150 pips a day. Pound USD, GBP USD moves about 140. Euro USD moves about 100. So you're just capturing just a piece of that, really. And that's on a daily basis per pair. So, if you're trading 3 to 5 pairs on your watch list, then you should definitely be able to grab that every single day. Okay. Or at least on average every day. Okay. So we're aiming for 60 pips. 1 to 3 risk to reward. So here's the power of good risk management. Okay. A lot of people blow through this section or pay it, tune out, because it's not some sexy strategy that they've never heard of. Okay. But here's the power of good risk management. So say you have 3 consecutive wins just on this pair alone. All right. So 3 consecutive wins at $10 per pip. You're aiming for 60 pips per trade. That will net you $1,800. Okay. So in order to negate that loss, it would take 9 consecutive losses. All right. So I don't even think, if you have no idea what's going on, I mean, the market's either going up or it's going down. Okay. So you can't tell me that you you would be wrong 9 consecutive times. That would negate this entire gain right here. Okay. So this is where it gets discipline becomes important, where adhering to your rules becomes important, right? Because what a lot of us like to do is we win a couple of trades, and then suddenly, we're super mega trader and we want to trade 5 lots. Okay. And now we're in massive drawdown, price is going against us, and we lose everything that we've made. and then some in one trade. Okay, so it's important to keep yourself disciplined. All right, so let's zoom in here to this entry. Okay, on Euro USD. I'm gonna pause this real quick. Okay, here we go. So we had. Let's go back out. Yep, let's go back out. So I know this is a crappy image. I don't want to go back to 4 hour, but for the sake of the example, all right, we had price. Um, price just got up out of this area right here, made fresh demand. Okay, it price just blasted through this level. Didn't even really get a solid bounce. So obviously we had some crazy U.S. dollar strength. All right, hasn't been retested, and here we come back for the retest. Okay, so on the retest, we see that the euro now is picking up a lot of steam. Okay, so going back to our rules, right? You have two options really. You could have option one, tuck your entry into the very back of the zone, especially if we're seeing all this momentum. I'm sure if you pull up the volumes would be crazy. So a lot of momentum. So I have no reason to believe that price is going to stall out in the front of the zone. So you could tuck your entry into the back of the zone. All right. Um, Technically, that would give you the best risk to reward ratio in this scenario. Okay. Or, and this is the more traditional route, so I like to teach, especially new traders, we wait for some sort of pattern to form. All right. So you have a nice double top. This is why I like to see that second push that gets rejected back down. All right. And then you could enter on a bearish momentum somewhere in this area. All right. All right, what's up, guys? I had to temporarily stop the video, go and check on my 2-year-old. Man, shout out to all the parents out there, any age kids, but definitely parents with them toddlers. We're all struggling together, y'all. We are all struggling together. 2-year-olds are a different beast. Okay, so now we're zooming into the entry. As always, throughout this course, I like to not just teach theory, but I like to teach application as well. Risk management in theory is great, but what does it look like on the chart? So here we have price coming back to retest this zone that was demand. Now it looks like it will be supply if we have enough sellers here. And as we've seen, we have a push, a second push. All right. And then we get a break. So as I had pointed out just a couple minutes ago, you have two possible entries here. So let's say you had your first entry. You see price coming in aggressive. You think that it's probably going to continue to the downside, but you're going to get a nice push into the zone first. So you could enter. I'm going to highlight this red, and I'm going to make this a little bit bigger. So you could enter right here, okay, at 1800. Okay, and again, so our stop loss based off this formula is 20 pips. All right, so we're putting our stops right up here. Scroll out a bit. 1820. All right. Give me that down. There you go. 1820. So you got your trade has a lot of room to run. Okay. And our target, because we're going 1 to 3, so we're aiming to get 60 pips in this trade. All right. Our target would be 1740. Okay. So this is our entry. This is our stop. And our target is down here. All right. So this is a 30-minute chart. All right. And this move right here, 60 pips. This is very doable. This happens over and over again. You just want to get a chunk of the market. All right. You could easily get that in a day. So let's get that out of here. So let's say you got in you got in here at the break of structure after the double top. Price kind of creeps back in a bit. You wait for a good entry, and let's say you get in at 1780. All right, so you get in right over here. Okay, so now aiming for 60 pips again. This would be your target right here. Okay. Price is going to head on down. Definitely grabs that target nice and easy. And your stop will be 1800 on the dot. Okay. So again, nice, good stop, solid risk to reward ratio. Just to recap, I mean, if you get one of these wins, which is very doable, as I've shown you, if you get one of those wins, it'll take you 3 consecutive losses to blow out that profit that you made. So I'd like to think that anybody who has made it through this course, or anybody who is serious about trading Forex, serious about discipline, they will not lose 3 times in a row to the point where it will blow their account. All right. So this has been a quick risk management video. Again, just to recap, determine what size account you're trading, decide on your max risk or loss per trade. I like to keep it at 2% of my total account. Determine your lot size from there, which will determine your stop loss, and then set a realistic risk to reward, guys. That is the key. Realistic risk to reward. All right. Watch this a couple times. Take down this quick math. All right. Thank you guys again for tuning into this video. And I just can't stress it enough. This is the most important video of the whole course. All right. If you guys are able to manage your money, to manage your emotions, and not overtrade, not revenge trade with big lot sizes, if you are stopped out, then your account will be safe. Your equity will continue to grow, and you will be a profitable trader in the long term. Okay. Thanks for tuning in. Stay locked into our next video. Peace and happy trading.